Welcome back to Investing Talk Podcast.
Today we're looking at Navitas Semiconductor.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Navitas is fundamentally positioned right at the heart of this big power transition.
Moving away from silicon, you mean?
Exactly. Moving the world from legacy silicon toward gallium nitride, or JN. And the recent performance, it's not just good, it's proof that this whole shift is happening faster than a lot of people thought.
Okay, let's unpack that then, the financial story. Because the numbers from last quarter, they really seem to back up what you're saying about that momentum.
They absolutely do. So Q4 2024 revenue hit $137.4 million.
Which is a pretty robust, 37% year-over-year growth?
37%. But here's the real headline for me. This is the 8th straight quarter of double-digit year-over-year growth.
8th? Wow.
Yeah. So that isn't a fluke. That's sustained execution in a market that's just blowing up.
And if we drill down a bit, that growth is almost entirely coming from their core technology, right? The GaN fast power ICs.
Correct. Those integrated circuits grew, get this, 52% year over year.
52%.
And now they account for about 2/3 of total revenue, sitting at 65%. It's just amazing how fast this tech has gone from a sort of niche component to the standard, especially in consumer stuff.
Right. I mean, if you're listening and you've bought a modern fast charger for your phone or, a new high-end laptop, chances are you're holding Navitas tech right in your hand.
You probably are. They've shipped over 150 million units since 2020, just in USB fast chargers alone.
And that kind of volume is key, not just for grabbing market share, but it's translating directly into better profitability.
Exactly. You look at the gross margins. In Q4, they expanded to 51.6%.
That's a huge leap from, 46% the year before?
46.1, yeah. It's a massive jump for a chip company. I mean, margins like that are usually for, software firms, not hardware.
And what's driving that? Is it just the volume, or is there something more fundamental going on?
It's definitely more fundamental, and it really speaks to their technical edge. There are 3 key drivers. First, yes, the manufacturing scale helps.
Yeah.
Costs drop with volume. Second, they're cutting packaging costs with a process called GaN on silicon integration.
Okay, hang on. Stop there.
Yeah.
GaN on silicon. That sounds like pure technical jargon. For the listener, what does that actually mean, and why does it help margins so much?
It means they're getting incredible efficiency by putting multiple complex circuits all on one chip. See, traditionally, you'd have the GaN switch, the silicon drivers, all these separate parts a customer has to assemble.
Right. A bunch of different pieces.
Yeah. With this integration, they're building the complex circuits right onto the same silicon base as the GaN switch. It just, it eliminates a whole manufacturing step, drops the cost, and locks in that higher margin.
So efficiency in production leads to efficiency in profit.
Yeah.
Got it. What was the third driver?
The third thing is rising average selling prices, or ASPs. They're just able to charge more per unit now.
Because they're moving into bigger markets.
Exactly. They're getting much higher value from the newer, high-power industrial and automotive segments, and that pulls the whole average up.
And all of that has led to a pretty big financial milestone, which kind of changes the whole narrative around them.
It did. Their operating margin jumped to 14.8%. This is the first time since 2020 it's been over that critical 10% mark.
And why is 10% so important?
For a high-growth semiconductor company, crossing that hurdle means you've proven you're structurally profitable even before you factor in all the heavy R&D spend. It fundamentally changes how institutional funds look at the stock. It goes from a speculative bet to a real growth story.
So they can make money efficiently. But the real test is what they do with that money. And that's where their balance sheet comes in. It's like a fortress.
Absolutely. Navitas is holding $426.8 million in cash and equivalents. And, critically, 0 long-term debt.
Over $426 million and no debt. That sounds almost conservative for a company riding such a huge tech wave.
I think it's a feature, not a bug. I mean, if you're selling mission-critical parts for AI data centers or EVs, your customers need to know you're not going to disappear in a downturn. That strength signals reliability. But what's really amazing is their cash conversion. Free cash flow hit $48.3 million last year.
Which is a 331% expansion year over year?
331%, yeah. It's phenomenal.
And how are they using that cash? Are they just sitting on it?
No, they're pouring it right back into growth. Nearly 80% of that free cash flow is going into R&D and a massive expansion of their capacity. They're working with foundries like UMC and STMicroelectronics to literally double their output by mid-2025.
Reinvesting 80% is aggressive. Are they risking getting ahead of the market, or is this just a necessary move to lock in that capacity before the big legacy guys can catch up?
It's a necessary move. It's all based on confidence in future demand, especially from enterprise. They know if they don't secure the capacity now, they could lose out on huge multi-year design wins down the road.
Which brings us to what's next. What's the market consensus looking like for 2025, given this huge build-out?
The analyst consensus is very bullish. They're projecting fiscal 2025 revenue will hit $534 million.
Which is still another 31% year-over-year growth on top of everything we just talked about.
Right, and the operating leverage is really expected to kick in because the earnings story is even more dramatic. Earnings per share, EPS, is expected to jump from 14 cents in fiscal 24 all the way to 43 cents in 25.
That is a huge jump, over 200% growth.
207%. It just confirms that all those margin improvements are flowing right to the bottom line.
And the general feeling, the sentiment, seems to be getting stronger, not weaker.
That's a really key signal for you listening. If you look at analyst revisions since December 2024, 6 of the last 8 have been upward. For both revenue and EPS, it shows the market is getting more and more confident they can actually deliver.
Okay, so we've got the financial health, the future looks bright. Let's talk about the moat. Why should someone believe this company can keep its lead against, the huge players like Infineon or onsemi?
The moat is all about integration. It's about control over the whole tech stack. Navitas is unique because they're a pure-play GaN provider that owns everything. The design IP, the driving circuits, the packaging, all of it.
So instead of a customer having to buy 4 different chips and make them work together, Navitas gives them one tiny integrated circuit that does it all.
Exactly. It's a unified solution. And because they control it end-to-end, they can reduce system size, cost, and importantly, electromagnetic interference EMI by more than 40%.
40% is a huge number for engineers building these things.
It's massive. And here's where it gets really sticky for them as an investment. The switching costs.
Ah, okay. So once a big customer, like an HP or a Dell, designs your chip in, how hard is it for them to switch to a competitor?
It's not easy. Not at all. Switching costs are really high because a customer has to spend 8 to 12 weeks on system validation. That's all because of the proprietary firmware inside Navitas's designs. So if you try to switch, you're not just swapping a chip, you're potentially delaying a massive product launch by 3 months.
That's the lock-in.
That's the lock-in. The design wins are sticky, and they are absolutely winning that battle for market share.
What are the numbers there?
They control about 45% of the consumer GaN IC market, and they totally dominate laptop chargers, with over 60% of that specific segment.
And that kind of dominance is getting noticed by the big players on Wall Street.
Oh, yeah. The institutional activity is a huge vote of confidence. Ownership jumped from 58% in Q3 of last year to 71% by Q4. This isn't just money flowing in. This is long-term growth funds saying, okay, the risk is lower now. This is a real secular story.
And it's not just any funds. It's some big names.
It really is. We're talking about firms like T. Rowe Price, Fidelity, Renaissance Technologies. When those giants start buying, it signals very strong conviction.
Right.
And, just to top it off, the CFO bought 10,000 shares personally back in March. Management is all in.
Okay, let's pivot to the really big opportunities. Beyond the consumer stuff that built them, I'm talking about data centers and enterprise.
Yeah.
This is the key growth vector, right?
This is where the story gets explosive. Data center power revenue surged 126% year over year in Q4. This isn't just nice to have growth. This is like a necessary infrastructure upgrade, especially with AI demand.
Why is GaN so critical in an AI data center?
It's all about efficiency and heat. AI servers need incredible power density, which creates a ton of heat. If you can make the power supply 40% more efficient with GaN, you slash the heat generated. That means less money on cooling, and you can pack more processing power into the same space.
And they're already getting traction there.
Oh, yeah. They've got tangible design wins with Tier 1 server OEMs. We're talking big names like Supermicro and Dell.
And this whole shift is getting some high-profile endorsements.
It is. Morgan Stanley just upgraded the stock, and they specifically called out GaN and data centers as a major multi-year opportunity. They see that GaN solves a fundamental problem in the AI build-out.
And they're still winning in their core markets, too.
They are. They just won a design with HP for their next-gen Omen laptops, which are getting these new 140-watt GaN-fast chargers. So it's becoming the standard for premium computing.
Now, for those of you who follow the charts, the technical picture looks pretty good, too.
Yeah, it has some strong indicators. There was a multi-month cup-and-handle pattern that broke out above the $25.50 level. That kind of breakout often signals a big move is coming.
And a golden cross.
And the golden cross, right. That was confirmed in March. The 50-day moving average crossed above the 200-day. That's a classic long-term bullish signal. Momentum is shifting up.
And whenever you get a hot growth stock like this, you get whispers, chatter. What are the unconfirmed rumors we should know about?
There are two really interesting ones floating around, but, they are totally unconfirmed. One is about potential server power supply contracts with a major search engine company.
That would be huge.
Massive validation. The other is about potential co-development of some 48-volt GaN modules with a prominent computer maker for the next-gen MacBook Air. Again, pure speculation, but that's the kind of stuff that really moves the needle if it's true.
Okay, we have to balance this out. Let's look at the downside. What are the biggest risks here?
The main risk is customer concentration. Two key customers, we think it's a major smartphone and PC company, and HP, they made up about 34% of 2024 revenue.
So if their product cycles get delayed, it hits Navitas hard.
Exactly. A delay on their end could seriously impact short-term growth. The other big one is just supply chain risk.
Right. They don't make their own chips.
Correct. They rely on outsourced foundries, UMC and STMicro. And GaN wafer capacity, while it's growing, is still tight globally. Any disruption there could stop them from meeting all this demand we've been talking about.
So how are they dealing with that? The customer concentration and the tight supply?
They're being very aggressive. To diversify, they locked in over 160 new design wins in 2024 alone. And on the supply side, this is crucial, they have secured $180 million in multi-year wafer commitments that go all the way through 2026.
Okay, so that supply risk seems pretty well managed for the next, say, 18 months.
It does. It looks like it.
So the bear case, then, it really just comes down to valuation, which is pretty rich.
It's unavoidable. It's high. We're talking around 78 times forward price to earnings. The stock is priced for near perfection.
Meaning if there's any slip up.
Exactly. If there's a macro slowdown in electronics, or if a competitor suddenly makes a leap, the stock could pull back hard just because that valuation is so high.
All right, let's wrap up by looking ahead. What are the key catalysts in the next 3 months we should be watching?
The biggest one is the Q1 2025 earnings release on May 7th. The consensus is for $148 million in revenue. That would be about 40% year-over-year growth.
And everyone's going to be watching the forward guidance, not just the results.
Absolutely. Wall Street will be looking for guidance on new orders for AI server power supplies and high-end notebooks. Strong guidance there could send the stock higher.
Yeah, there are a few industry events coming up, right?
Yes. They're presenting at the Tech Insights Power Electronics Forum on May 20. They're expected to unveil a new 650-volt GaN-fast IC specifically for AI servers. That's a direct shot at the highest value part of the market. Then in June, we might see a partnership announcement in automotive, maybe for EV charging, at a conference in Europe.
So to bring it all together, this is a company riding a huge technological wave. Navitas is the leading GaN and pure play. They had these big structural tailwinds from the efficiency shift across laptops, data centers, EVs.
And the foundation is solid, the institutional interest is there, the operational execution is proving out the story. It really represents a fundamental shift away from old power solutions. The strong execution, the expanding margins, that fortress balance sheet, it all positions them really well for multi-year growth, even if the valuation demands perfection.
Now, the final provocative thought for you to consider. If YAM becomes the mandatory standard for all high-power AI infrastructure, and the evidence suggests it might, how much larger does that 78x valuation suddenly look? If you enjoyed this analysis and want to stay ahead of these key market shifts, make sure you subscribe to the podcast again.